Yeah. Surprise, a little different than you used to. Yeah. Dropping these bars on YouTube, knowledge I introduce you. Yeah. We chasing this money like it's the prize, it's the voodoo. Fugazi, fugazi, it's just a lie we buying into. We need some cars on deck. Get the rollies, get the Moe, all the Mars on deck.
All right, good afternoon. We just heard from the Bank of England. Rates have gone up to 5% as expected. But obviously, this is going to be a point of our conversation this afternoon. This is something I said that I was going to do earlier in the week. And thank you to everyone who didn't tune in yesterday because the meeting was today and I got my days mixed up. I'm allowed to do that. It's all right. It's all good. But anyway, right. Is this good news or bad news? I don't really know. That depends on your perspective. That depends on where you're coming from. What I want to do in this live, though, is kind of just have a little look at how the media is kind of reporting this. Then we're going to have a look at the Monetary Policy Committee summary. So the minutes, their thoughts, so on and so forth. There's one particular thing in the minutes or in the summary that is actually quite interesting. There are a couple of things actually. And I think they're worth talking about because it kind of sets the scene for what we might expect later on. Remember, guys, that this is very much a case of we hope that this new measure works, because if it doesn't, they're going to have to keep going. So the hope is that this 0.5% increase today is going to further reduce the inflation number the next time they meet. So we'll see it go down from 8.7 to hopefully around about 8 to the 7.5% mark is what we're hoping for. And everything's crossed on this. Everything is crossed on this, because if it doesn't, that presents a huge problem. And this is where many people are speculating that actually the Bank of England and the guys at the Monetary Policy Committee are actually starting to panic, because it proves that inflation is deeply entrenched past the basket of goods that they typically use to measure inflation. So let's have a look at how some of the outlets are basically reporting this today. Let me just swap over screens right here. And by the way, guys, if you do get value from this live, please make sure that you smash the like button. And if you haven't already subscribed, please do consider subscribing. We're at 41, just under 41,500 at the moment. It will be great to get the subscription count up to 41.5, actually 41,500 exactly, or even more by the time we finish this session here. So this is BBC News. It's interesting because when you looked at the web browser for BBC News earlier on today, they positioned this as a shock move. And I'm like, how is this a shock move? Like, we've been talking about this now for the past 2 weeks. It's been signposted for at least for the last 3 weeks. So how can this be a shock move? This is something that, by all accounts, was expected to happen, because they've told us, look, the likelihood is we're going to have to increase interest rates. And they do this so that people are prepared, so it doesn't come as a shock. So it says here, interest rates. Bank of England governor warns rate rise hard for many. And we know that it is. Now, the silver lining here is that obviously over the past 2-3 weeks, we've seen a lot of mortgage products be pulled from the markets. And we have seen now the average 2-year fixed rate as of today hit 6.19%. It's pretty mad. I think earlier in the week was something like 6.02, so 6.19%. If there is a silver lining in this, I would expect that despite the bank rate increasing even further today, we've got confirmation of this, hopefully what the mortgage lenders have done is they've increased the rates, having factored in that this was going to happen today and the bank rate was going to move to 5%. I was on BBC's Sound Advice day before yesterday, and they asked me, what do you think is going to happen? And I said, I wouldn't be surprised if they put a 0.5% interest rate rise in to take us from 4.5% to 5%. And that's essentially what's happened today. So there may be a little bit of a silver lining for mortgage holders. Now, in previous lives, I've offered a little bit of help, a few things for you to consider. If you are in a mortgage right now with your fixed rate ending, there are probably about 800,000 mortgages or so left over that will be coming off their fixed rate in the next 8-9 months or so. And I've offered some thoughts on that. So make sure you're able to get fixed in right now, have those conversations now. I know that this week I managed to get locked into a 4.75% fixed rate. So we know that there's going to be a lot of pain, but I mean, Sky are kind of just going over some very, very interesting, BBC, I should say, are just going over some of the highlights. Here we go. This is just talking about the average 2-year fixed rate on a residential mortgage now being 6.19%, while a 5-year fixed rate is 5.82%. I mean, if you look back to last year, this time last year, this is a doubling of mortgage rates. I mean, they were close to about 3% at that point in time. And so what is going to happen from here on out, we don't really know. I do want to have a look and see how Sky are kind of reporting this. I would assume it's going to be a little bit more of the same. The Bank of England has shocked economist. This is something that has been mooted for a while. It's not a surprise. Like, I don't know why they would have been accounting for this by a long mile, and investors by raising interest rates 0.5% to 5%, the highest level since 2008. I might show you a graph of the interest rates at the moment just so you can see where we've come from and where we are right now in context to what has happened previously. If you pay attention to the comment section of this channel, you'll find that there are a lot of people who have lived through much higher interest rates, and they will always say that this is something really that I guess we should be prepared for, because historically we've seen rates much higher than they are currently. And that's one of the reasons why I keep saying to people, don't look at this situation right now and just assume that inflation is going to tail off, interest rates are going to come back down, and then we're going to be all of a sudden miraculously back at 1.42% for mortgage rates. I think those days are long gone. It's saying here, and we'll get into the Bank of England summary in a moment, economists had expected the Monetary Policy Committee to raise interest rates by only a quarter percent. But the embassy voted 7-2 for the surprise increase. So the surprise for them is that it was going to go up by 0.25% and opposed to 0.5%. And to be honest, I don't know how they would have expected the bank to go with a 0.25%. That stance, for me at least, would have been deemed to be maybe not strong enough. I mean, look, we've just had inflation fall from 10.1 to 8.7. The target for inflation for Q2 is 7.5%. So we're still a way above it. If they went with a 0.25% rate increase, they could be accused of not taking strong enough action, as they have been throughout this entire ordeal over the last 14-15 months of inflation increasing. They haven't been decisive enough, and I think this is just a decisive moment where they thought, look, we can see that it's kind of worked. We've seen it go from 10.1 to 8.7. Let's be aggressive and go for another 0.5%. So apparently the economists were surprised. So this is what I'm talking about here. It comes after the UK official interest rate, inflation rate, failed to fall as expected in May, staying at 8.7%. I will bring up another screen in a moment just to show you guys what the actual target is, because I think it's always nice to kind of reference back to what the targets, the government targets are for these things. And they have changed throughout this year. If you've been following me since January, you'll know that at some point the inflation target was going to be something like, at the end of the year, I think it was 2.9%. This is it right now. I've just found it here. So this is the inflation number, right? Actually, they've revised the inflation number to 8.3. So if you watch one of my videos from probably about 2 weeks ago, that number was 7.5. This has now been revised to 8.3. So what they're basically saying is, by looking at this 0.5% increase in the Bank of England base rate, this is where they need inflation to hit now, 8.3%. The target for Q4 is 3.9%. It's still some way above 2%. It's almost at double, but it would mark a significant improvement on where we have been so far. So look, these things will always move. When are we going to get to the 2% mark? They're probably pushing 2024 before that actually happens. I will talk about something else that came through in my I got an email earlier today, which will actually help these numbers quite a bit, but I'll come back to that in a moment. But that's the target. The revised target right now is 8.3% for inflation. So watch this space. Watch this space, because if over the next month or so, when the next CPI data comes out, we're not at 8.3%, the Bank of England is going to have to move even further. So that's the, let's just go back over to the Sky report. Is there anything else here that's worthwhile just kind of browsing? There isn't. I do want to show you this. And this is the monetary policy summary for the meeting today. And I just want to highlight this section right here, okay? It says, at the time of the previous MPC meeting and May monetary policy report, the market implied path for the bank rate averaged just over 4% over the next 3 years. Since then, gilt yields have risen materially, particularly at shorter maturities, now suggesting a path for the bank rate that averages around 5.5%. Now that's quite telling. That's quite interesting. So, do you remember the disastrous budget from Kwasi Kwarteng and Liz Truss? And you remember the cost of government borrowing basically spiraled out of control. We're back where we were. And this is what this is referencing. For the government to borrow money, it's become very, very expensive now. And that's what he's referencing there, particularly over the short period. So 2 years, 5 years, right? Expensive. So we're back where we were when that disastrous budget happened. I think it was in October or something like that, right? So around about there. Could have been, I think it was about October. I'm sure it was October. But we're back where we were now. So this is saying that, it lays the path for the bank rate that for a bank rate that averages 5.5%. And remember what we've been talking about? We've been talking about the fact that the bank rate could go up to 5.5%. It's all predicated on this kind of stuff. Another factor which they mentioned here, which I actually found quite curious, which is a really good conversation point, is this bit right here. It says annual growth in private sector regular average weekly earnings, right? So this is pay, increased by 7.6% in the 3 months to April. And that's 0.5% above the expectation at the time of the May report. Now, I don't know if you remember. Let me just go back onto solo screen here, just so we can talk about this and you can see me clearly. I don't know if you remember, but Andrew Bailey got a little bit of stick for saying that people asking for pay rises was going to be a bad thing for inflation. This is kind of what he's talking about here. So what he's saying is that the average weekly earnings has increased by 7.6%. Okay. And on the surface, that is good for person receiving said increase in income. But what that basically means is that you now have more money going after the same goods and the same services, which exacerbates the increase in the price of those goods and service. Imagine everyone was a millionaire, right? Everyone had the same amount of money in the bank right now. So let's just say we all had £1 million, right? Do you really think that a loaf of bread in Tesco's is still going to be the price that it is right now? No. They will increase the price of the loaf of bread because everybody's got the same amount of money. There's a lot of cash sloshing around in the system. And this is one of the things that, where you start getting this conversation of pay rises are bad for inflation. And whilst that is counterintuitive, this is evidence right here. And it's one of the reasons why they've also increased the Bank of England base rate today by 0.5%. Now, interestingly, and I don't mean to put the bejesus up anybody when I read this next bit out, but when you go straight into the details of this summary, I do want to read you this point right here. I'm not trying to scaremonger, okay, but I do think it's really important that we pay attention to the language being used by the guys who make these decisions. Okay, so again, don't shoot me. Don't accuse me of trying to scaremonger people. I'm not, but I do think it's worth everyone being aware of what they're saying. So it says here, the MPC would continue to monitor closely indications of persistent inflationary pressures in the economy as a whole, including the tightness of labor market conditions and the behavior of wage growth and service price inflation. Wage growth and service price inflation. So what they're saying here is, and one of the big fears is that, it's not just about the cost of like the things that go into the CPI basket when they're measuring inflation. It goes beyond that. So they're going to continue to monitor this, but this is the real killer. If there were to be evidence of more persistent pressures, then further tightening in monetary policy would be required. So again, going back to our forecast right here, where it's been revised now from 7.5% up to 8.3%, this bit right here, if at the next inflation checkpoint we do not hit this target, they're going to seriously be considering pushing interest rates even further. Harsh truth. But I think this is important for you to be prepared. Now, I had a conversation with someone for my podcast, which actually that episode is going to be out on Monday. So I encourage you to go listen to that. And I get a lot of people who actually say the following to me. They say people shouldn't pay attention to the news. The tabloids and the news industry, that whole engine, they hype up a lot of stuff and they try to scare people. I don't agree with that. And I'm not saying that you should agree with me, but let me put my perspective forward. Now, if you ignore the news, like we all know, right? It's part of business to be clickbaity, to be hyperbolic. We know this already. So with that in mind, we can pay attention to the news, but take it with a pinch of salt. Now, if you ignored the news and said, oh, everything that they print is just rubbish, they're just trying to hype people up. A lot of the stuff that has happened in terms of mortgage rates, interest rates, all of this kind of stuff will be completely off your radar. And so what I'm saying here is you should be paying attention to the news, but obviously take it with a pinch of salt and try and read between the lines, try and see the wood through the trees. And that can be very, very difficult to do. In times like this, the government is going to signpost what is coming next in the news. And if you're not paying attention, you are not keeping up to date. You're not going to know what's going to happen. It's like literally walking into the road without looking left or right. You step in and you get wiped out by a lorry. That's essentially what it's like. We have to be aware of our surroundings. We have to be aware of what's going on around us as well. So pay attention to the news, but please do take it with a pinch of salt. Now, one other thing that's happened. So inflation, if you think about it, the increase in costs and goods and services. I got a message yesterday, an email yesterday, and you may have got a bit of communication from your energy providers yesterday. Energy bills are going down. I'll see if I can find this email. Apparently, my energy bill is going down, and it's going to be going down to the tune of about 300 and I think it was 80 something odd quid a year, I believe it was. British Gas, here we go. What are my savings? £398.59 is the difference in my tariff right now. So my tariff is going to go down from £2,575.10 to £2,176.51. Why am I mentioning this? Well, energy prices has been a big contributing factor to the increase in inflation that we've seen, right? So we know that wholesale energy prices have fallen for quite a bit now. This is now starting to trickle through to households. Typically, it takes about 3 months. It feels as though we're at that point now where it is going to start filtering through to households. So if we go back to this figure right here, and this is what we need to see from 8.7, which is what the interest rate is right now, the good news around energy prices coming down, tariffs falling, is going to be good news for where we need to be, 8.3%. So is it all doom and gloom? No, it isn't. I think there is a good chance that we can hit this. I mean, look, party politics aside, whether you vote Tory, Labour, Green, Lib Dem, whoever, you should be hoping that they get this right. Not for their sakes, not for the sake of the next general election, for our sakes, for your sakes. Because if they get it wrong, they individually will be fine. All of these politicians are going to be sweet. We're the ones who are going to suffer. And I think that's really, really important. We need to give them, or at least, I won't say give them our support, but we do need to hope that they get this right for our sakes. Because if they get it wrong, you know, mortgage prices, mortgage rates are going to continue to increase. It's going to put even more squeeze on household incomes. I mean, first-time buyers, it may lead to a property crash, which many people will argue is not necessarily a bad thing. But I think we do need to try to be as... Oh, just dropped my mouse. We do need to try to be as optimistic as we possibly can, given where we are right now. And that's kind of my analysis for what's happened so far. today in terms of what we were expecting. Like I said, this has been signposted for weeks. It shouldn't be a surprise to anyone. It is very, very likely that we'll probably see them push even more, particularly if we don't hit that 8.3% mark target at the next inflation check-in. So there we are. Let's have a look and see what we have in the questions. By the way, guys, if you have not yet smashed the like button, what we got here, let me just double check this. Right, so there's 79 of you on here right now. How many likes have we got? We've only got 12. Come on, guys, let's get this up to about 50. See, the reason why I ask for likes is because after all this is said and done, what the YouTube algorithm does, it looks at likes, it looks at how many people have watched it, how long they watch for, and then they decide whether or not they're going to push this to other people who may benefit from what we're talking about. And if the likes stay at 12 or 17 as they currently are right now, YouTube will just assume it was rubbish and they never push it to anybody else, and that doesn't help my channel grow. It also doesn't help other people get access to what we've spoken about here today. So please do smash that like button. That would be amazing. Let's have a look and see what's actually been said in the comments right here. Chaos Lord is asking, does the 5% rate only affect those who have mortgages or anyone with a loan and or credit cards? Yeah, so it is mainly for borrowing. So if you have credit cards, if you have loans, you're likely going to see that new loans and new credit card rates, well, credit rates can actually move during terms. But if you're in a loan that's already been agreed, you should be fine. But new loans will become more expensive. So it's the general cost of debt that this basically impacts. SR is saying here, hi Pete, today's interest rate increase is going to be devastating for many, especially those with fixed rates coming to an end. Yes, mate. And I would encourage you guys, please go and watch the previous live that I did. I'm going to see if I can just bring up my channel and I can share with you which video you need to watch. I gave a lot of tips for people to basically consider if you're in a fixed rate mortgage. I don't want to go back over those tips here, but if you're in that 6-month window, you should be speaking to someone right now, like literally right now. Luckily this week I was able to lock in at 4.75%. My mortgage comes to an end in October, so I've locked in that lower rate now. And if things change, if by miracle inflation falls dramatically and they decide to reverse on interest rates, and by the time my mortgage comes up, there is a rate on the market for 4%, I can still go get that lower rate. But right now, given where we are and what we're seeing to be the writing on the wall, I'm locked in at 4.75%. So the video that you would need to go and watch is let's share this one. Let's come back over here. It is this video right here. So the mortgage time bomb, here's what you do. I offer some really, really useful and practical tips for anyone who may be in kind of a situation where they're worried about their fixed rate. I mean, the sad thing is, right, during the lockdown, if you remember, the government did this whole stamp duty break thing where they encourage people to go buy properties. Now, for first-time buyers, I'm really, really worried for the first-time buyers who probably took that opportunity to buy a property, their first property. They may have fixed for 2 years. They may have gone and got the mortgage based on a 95% loan to value. We know from data that when you look at house prices from August last year to now, property prices are down 10% on average. Well, if you were a first-time buyer in 2021 who took advantage of the stamp duty and you took a 95% loan to value, not only is your mortgage going to be coming off if you took a 2-year fixed rate, so you're going to be going from what would have been probably 1-2% rates at that point to 5-6% now. You're going to see £200-300 increase in your mortgage per month immediately once you come off, and then God forbid you are in negative equity because property prices have fallen. It's a really, really tricky place right now, and many people are going to feel the pinch on this. They really, really are. Rishi has been asked whether or not the government should step in. I did a poll on Instagram actually yesterday asking this question: do you think the government should step in? I personally don't think they should, but many people are arguing, well, they caused this, so they should. I mean, I don't have the answer, but at the moment, Rishi's ruled that out. It's a very, 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 very precarious place that we find ourselves in right now. Joshua's saying here, wonder if they'll drop rates prior to election. I don't think they will, mate. Listen, I think the Tories at this point in time, they realize that they basically shit the bed. They know that Labour will be the ones in power. And this is the thing. I don't necessarily think that Labour are going to be able to fix this either. I mean, the issues and the contributing factors to inflation. I mean, the war in Ukraine has been a big one for energy prices. That's coming obviously down now, but there are so many other factors that are outside of you like monetary policy, outside of governmental policy control. So hopefully they do it. And I'm rooting for whoever makes it into office next time. But I think the Tories know that their time is basically up, and they wouldn't put down rates just before the election. I mean, well, I say that me being skeptical, but if they did, everyone will be able to see through it. You've dropped rates just for political reasons, and to be honest, it's not Rishi's job to drop the rates. It's down to the Andrew Bailey and the 9 committee members on the Monetary Policy Committee, and they have to be politics neutral. So I don't see that happening personally. I think they pause on the rates now. Mate? I don't know. I think everything that we've covered in this live so far, I hope they do, but it's heavily going to be dependent on whether we hit that 8.3 target at the next CPI check-in. If we don't, they're going to keep going. They're going to have to, because if they don't do anything, they'll be accused of doing nothing. So hopefully you're right, but time will tell, I guess. Hey. So you're saying, how does it affect the housing market? Well, this will be interesting to see. Mortgages are going to be going up. Mortgage payments are going to be more expensive. So this does lean more and more to the argument that property prices will drop, and it could potentially, if it gets really, really bad, lead to a property crash. But at this point in time, we just don't know. So again, it's just going to be a wait and see. Pay attention to your local property market and see what's going on locally. I'm leaving the country next year to go to Australia. What should I put my money in the meantime? Well, if you're only like going next year, mate, then you're only 6 or 7 months away. Don't be putting your money into any stocks or anything like that if you're going to need access to the cash. So high yielding account, NSNI premium bonds, tax free, something like that probably will be good. But don't go and invest the money if you're going to need access to it, particularly with the markets being this volatile. Edna, how you doing? How is everyone? Thumbs up. Thumbs are okay. Good. Welcome, Edna. Thank you very much. Sean's asking, Pete, do you think the Bank of England will purposely trying to create a recession in order to get inflation under control? That's a really good question. I think if you listen back to Jeremy Hunt and the interview he gave, I think it was on Sky or BBC, he was asked, would you support the Bank of England pushing on interest rates even at the risk of a recession? And I covered this on the channel, and his answer was he gives them their full backing. And so they're not shy, and they're on the record to say, and this is why, people will say don't pay attention to the news. I'm just like, come on, like it's too lazy a narrative. It's too lazy a narrative. Like, they're telling you, and it's being signposted in open conversation on Sky and BBC. I encourage the Bank of England to do what is necessary, despite the fact that it may lead to a recession. And you're seeing from the Bank of England, and I'm just going to show this again, because I think this is really, really important for us to kind of grasp, right? Show this again here on point 47 of that summary meeting. The MPC would continue to monitor closely indications of persistent inflationary pressures in the economy as a whole, including the tightness of labor market conditions and the behavior of wage growth and services price inflation. If there were to be evidence of more persistent pressures, then further tightening in monetary policy will be required. They are telling you, we will continue to push on rates at the expense of a recession. They're saying it. They're being honest and open about it. So to assume that they would be, just saying it just for the fun of it, I think is dangerous. And I think we should take that into consideration when we're following this news, in terms of just being aware that this is what they're saying and understanding, right, okay, so if we miss that 8.3% inflation target at the next check-in, right, what do we think is likely to happen? They're probably going to push the interest rates even further. What does that mean for you personally? If you have a mortgage and you're coming to the end of a fixed rate, well, you should be speaking to someone about getting a fixed deal right now, regardless of what you think the rate is, whether you think it's a good deal or a bad deal. Because we think that that is what's going to happen, we can only make decisions based on the information we have right now. A lot of this stuff will change, and I guarantee you, in about 4 months' time, if everything's gone the opposite way, someone will be in the comment section telling me, "Oh, you got that spectacularly wrong, Pete." It's like, I don't have a crystal ball. We're only reporting and commenting on what we know right now so that we can position ourselves to make the best decisions. And I don't know about you, but personally, I would rather lock into, and I've been lucky to get a 4.7%, but I would have locked into a 5% if I had to, because the indications are that at the moment we are going to continue to see interest rates rise. And actually, this is probably a good point for me to actually bring in historical interest rates, just so that everyone is aware of the landscape of where we have come from and how unnaturally low interest rates have been over the past, what, 10 years, I would even argue right now. I just need to switch this over. Bear me 1 second, guys. Let me just get rid of this. And let's go back into here. Let's hide that. I just need to show you this because this is really, really important for you to see. And again, I've shown this a number of times when I've done lives, right? This is our interest rate curve in the UK. This is our history. You go back to 1980s, and there'll be plenty of people who watch this channel who remember these days. What is that? Over 15%. It's unheard of right now. Unheard of. I mean, even if you go back to 1990s, 15% bang on. And what we've seen since the 1990s is interest rates basically come down. And we've been stuck at what? Just sub 1% or teetering along at 1% since 2010. We're now reversing that curve, and all of a sudden, everyone thinks this is the end of the world. It's like, in the context of what's happened, no, it's not. Like, this is nothing. This is nothing compared to this. I know it doesn't feel like nothing when it comes to your finances and how much it's costing you on a monthly basis, but in the scheme of things, once you take out personal circumstances, it's nothing. We are back at where we were back in 2009-ish. We're back where we were then. I mean, rates haven't been this high since 2008. So it feels like we're reversing course right now. Will we see interest rates at 10%? I don't know. I hope not. Because the reality is that during this window right here, right, this window right here, from 2010 right up to the present day, what this period has done is has allowed people to fill up their boots on debt, on cheap debt, buying cars that maybe you couldn't have afforded, but actually it's cheap, so I'm just going to stretch, right? It's allowed people to fill their boots on debt. This is when it comes back to haunt you. And this is why conversations like, understanding what your financial goals are, understanding and having a plan behind it, understanding how debt works, understanding how you control your income and your expenditure, not living paycheck to paycheck, having the mindset and understanding the behaviors that don't serve you well. All of these boring topics that we talk about here are fundamental to the foundations that you need to be successful financially. And I have to say again, for the young people who watch this channel, it does not matter whether you're earning 10 grand or 15 grand a month like TikTok is telling you to. If you don't have the foundations in place, you're the same as the person who earns £1,000 a month and is broke. I have met so many people during my career that I've advised as a financial advisor who make extremely good money, but they're broke at the end of the month. Like, you honestly wouldn't think that it's possible, but it is possible because people adjust to their lifestyles. They don't check their behaviors. They don't check lifestyle creep when it happens. And all of this stuff is subconscious. It happens subtly in the background. Now, those behaviors will start to come back to haunt people. So it's really important to get back to basics and understand what all of this means and how you go about cultivating the right kind of habits, taking control and understanding how your behavior actually helps you. I mean, I've spent most of this week designing um, questionnaires which target behavioral patterns so that you can understand, for example, why is it that I get paid all this money, then I'm just broke at the end of the month, when you know that you have enough money, you make more than enough money, but the money is all just gone at the end of the month. Drop my mouse again. And so I'm going to be launching that in the next week or so. And they're online things, and it will give you an analysis, it will give you an interpretation, it's going to give you recommended points of action. This kind of stuff is very, very important, stuff that we don't talk about, or were never taught about in school. We don't talk about enough as adults, but they are telling, and they are really important topics and milestones for us to make sure that we're approaching and dealing with accordingly. Right, let's have a look and see what everyone else is saying. So yeah, someone's just saying here that they bought a house in the lockdown, 2-year run out in March. So I did a 5-year from April. Mate, well done. Hopefully you got a decent rate in March. Hopefully you got a decent rate in March, mate. But well done, and congratulations, because you bought a house at the end of the day and you took advantage of it. Hopefully you're going to be okay. You're locked in now, so you should be sweet. From where will the government pay the interest on its debt at these rates? Oh, mate, listen, there isn't enough money there anyway. I mean, talk about money printer, but that will make things even worse. I mean, I don't even want to think about what our debt is. Actually, what is our UK? Let me just double check this. UK national debt. I need to have a look at this number, because when you look at it, it is mind boggling. Like, your brain cannot compute the numbers. It's absolutely mad. Debt clock. Here we go. UK debt clock. Oh dear. Oh, let me see if I can find a live one. Okay. Have a look at this. Have a look at this. And honestly, when you see this, and forgive my French, you tell me how we're not fucked. I mean, seriously, what is that? 2 trillion? That's 2 trillion. So the UK national debt grows at a rate of £5,170 per second. That's that's what you're seeing right there. So the last 3 seconds, well, that's 4 seconds, that's 20 odd grand. Tell me we're not absolutely fucking screwed. I mean, seriously. I mean, this is where people start talking about, cryptocurrencies and, what that might mean for a reset. But this right here is unsustainable. If this was personal finance, game is done. It's over. It's a wrap. You're bankrupt. You go on your merry way. You try to fix it later on and come back stronger. Because obviously we're a country. We have the money printer. And we've been printing way too much money. Way, way, way too much money. And this is where we find ourselves. So, how they can afford to pay any of that, I mean, and then bail people out and do whatever it is that they need to do, I have no idea. But we just have a system that is completely and utterly unsustainable. It's absolutely bonkers. I feel as though, like you said, a lot of people still have a surplus of cash. A development we have looked at has not struggled really to sell, whilst houses are on the market for longer. This is true. I mean, look, at the end of the day, depending on where you buy, or you're looking to buy, the simple matter is we have more people want to buy properties than properties for sale. And to a certain extent, that gives the property market a little bit of resilience. Because if a property goes on the market today, there is going to be someone, a group of people, a long line of people, I would argue, wanting to buy that property. And I tell you right now, what some of the estate agents are doing is they'll know, right, okay, the property market is down about 10%. They will increase the list price of a property, because by the time you start negotiating, they're probably going to get what they were looking for in the first place anyway. So is this going to have a real material impact? Only time is going to tell, but there are always going to be people who want to buy property. Stagflation incoming. I made a video about that about a year ago, just as inflation was kind of propping, starting to come up. And that was an interesting one. Didn't really get a lot of views and stuff, but it may be more relevant. I may need to revisit that topic as well, because quite possibly we could be in stagflation territory. Getting pay rises is bad for inflation. People provide goods and services, then get paid according to the market rate. What's bad for inflation is getting money for nothing in return. Is not bad for inflation, is what you're saying. That's not how economics. That's not what economic theory states, though. Economic theory states that if you have more money in circulation in the economy, the more people spend, that drives up the cost because supply versus demand. You have more money going after the same amount of things. And that's why getting pay rises is inflationary. I get your point around people are paid the market rate, but even from a business point of view, if they're giving, if your employer gives you an 8% pay rise, guess what they're going to have to do? Increase the price of their goods and services by 8% because they have to make profit. If they don't make profit, the business doesn't exist. So you get a pay rise that is going to be passed on to consumers. We've seen it with energy prices. Not that they had to pass it, well, it's costing them more money to be able to get it, so they pass that cost on. That's what you do in business. So pay rises are inflationary. To say that it isn't economically or theoretically correct, but I get what you're saying in terms of, people are paid the market rate, but that rate has to be passed on in some way, shape, or form. What else we got here? Let's have a look. Yeah, past what? So true. Imagine, imagine making like 10 grand a month, but you owe 11 grand out. That's exactly where we are, right? We owe more than we earn. Like I said, if it was personal finance, you're done. You're finished. Game over, kaput, done. Aziz, you're dead. You're done. But this is government, so hey, we trundle on, right? It's insane. It's not sustainable for sure. All right, last comment on here. Time to aggressively pay off the mortgage. Bye bye luxury holidays and nice cars. Look, I'll tell you right now, and I've said this on the channel a couple of times. I am now rethinking my whole kind of like long-term ish plan. Generally speaking, I was more than happy just to throw money into the markets and just the mortgage is there. It's completely fine. There are certain things that are changing for me at the moment. Certain moves that we've been planning for 2 years that are now coming to the forefront, and we're looking to press the go button on those. But the whole interest rate thing, it's just kind of made me rethink the whole overpaying my mortgage. I'm going to be paying a large chunk of my mortgage in probably about 4 weeks' time. And I think for me, going through the calculations and looking at things, I started to realize that if I work really, really hard, and I'm always conscious when I say these things that people just think, oh yeah, Pete, you're making a ton of money. Of course, you can say all this kind of stuff, but the reality is I have to work really, really hard to make this happen. But in 2 years, I could potentially be mortgage free, and I don't mind the idea of that. I think if I fast forward to 2 years and think about myself being mortgage free, I think it will probably give me a bit more headspace, and it will allow me to reevaluate the work that I like to do, the things that I don't want to do, maybe structure my life a little bit more. I quite like that idea, but there still needs to be a lot that happens for me to be able to make that happen. And I think many people are in that place right now where they think about, you know what, maybe we sacrifice a little bit for the next 2-3 years for the much longer term benefit of being mortgage free and being able to really live life at your own pace and do things that you want to do because you want to do them, not out of necessity. And that's really the principle that I try to kind of convey in my book. How to become your own financial hero, the money basics. It's, being your own financial hero is not about being a millionaire and having trillions of dollars in the bank. It's about being in a position where you can make financial choices, life choices out of freedom and not necessity. Like, if you really hate work, quit work because you can, because you've got an emergency fund, because you haven't got a lot of debt, because you've got your finances in order that allow you to make those choices, as opposed to going to work because you have to. You've got to pay for the car, you've got to pay for the mortgage, you've got to pay for this, you've got to pay for that. I know that is very utopia in an idealistic, but isn't that where everybody wants to be? The difference is not a lot of people get there because either, number one, they don't realize how to get there. They are too caught up in day-to-day life to really want to look at it. And, some of it, and I will say this openly, because I was there once upon a time, too afraid to look at it because It means you got to change some things, and you got to address some things, and you have to break old habits, and that's hard work. It really, really is. I can tell you that from experience. But once you come out the other side, it is so worth it, so worth it. I consider myself extremely lucky. I don't have any debts. I don't have any credit card debt. I don't have personal loans. I don't have a car finance. I only have the mortgage, and that will be my last debt. If I pay it off in 2 years' time, I am completely and utterly debt free. And just the choice and the peace of mind and just the freedom that you feel. I mean, the freedom that I feel now is pretty cool because I get to do this, right? And I don't make a lot of money on YouTube as doing these lives specifically, but YouTube is affording me to be able to write my book and to do some work in TV and to do coaching and do public speaking. That's how I make money, really. I don't make money from doing these lives or videos necessarily, unless I get a sponsor who sponsors the channel. And sometimes people even have a go at me for that. Why have you got someone sponsoring your videos? It's like, dude, I've got to pay bills too, but I find myself in a fortunate place. But it's taken me a long time to get there, and it's been years in the making to get here, and there's still work to be done. And so, look, I'm not a shameless plug or anything like that, but my book is literally right there in the corner, right there. The QR code with the red arrow is how you pick it up. It's an audio book, a physical book. You can also get it on Kindle. I share a lot of my story and a lot of the stuff that I've done to get me to this place, and have a little read through it. I mean, I've been told that it's a great read. I've got really good feedback and reviews from it at the moment. But I just want to encourage everyone. Like, it is very, very difficult right now, but try to make your decisions based on the fact that you can only make the best decision based on the information you have. And as long as you're happy with the choice that you make, either to fix or not to fix, or go on to a tracker or a discounted mortgage, or God forbid, a standard variable rate, as long as you're happy with that choice and you're able to sleep at night, that is the most important thing. Please ignore what other people are doing. Don't measure your success or your degree of happiness by what someone else is doing. That is the worst thing you can do. We have to be appreciative and just take solace in what we do have, and understand that actually what we have right now is probably a lot better than what we had 2 or 3 or 4 years ago. And I think those moments of gratitude are so important, particularly when it feels as though we're being squeezed left, right, and center. Like, it's hard. It really, really is. And when I coach people and I talk about their situation, people sometimes just talking about it a lot of the time makes people feel like, oh my God, a weight's lifted off my shoulders, because they can just articulate how they feel, and they know that actually they're, number one, not in it alone. And actually, there are things that you can do to take control of the situation. So that's my encouraging speech for this live. Thank you so much for joining in. Hang on a second. One sec. I'm just seeing a few comments on here. Where are we? Okay, we're 48 minutes. Right. Let me just have a look at this from Rosalind. I have a joint borrower / sole owner mortgage, interest only, now paying £894 a month. I have no option than sell up. Only mortgage products I could get has got made redundant in pandemic. Gutted. Shit. That's a difficult one. That's a really, really difficult one. If it's interest only and you're doing £894 a month, it's either a large mortgage or you're on a high rate. You're not on a standard. It'd be interesting to know what rate you're on, whether you're on a standard variable or you're coming to the end of a fixed rate, whether you're on a discount tracker. It'll be interesting to know. It's difficult because, particularly if you've not found a job, the lenders are going to be all about income because they want to mitigate the risk. I don't know your situation, Rosalind. So it's hard to comment, but my head is just thinking, okay, right, what are possible ways around it? And you may have to look at things that aren't necessarily comfortable. Okay. Oh, fucking hell. Yep. 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 See, this is they would describe you as a mortgage prisoner because you have nowhere to go. You can't go fixed. You can't go tracker. You can't go discounted. You're stuck on a standard variable rate. And the danger, and I completely get what you're saying. The bank rate going up right now for you is bad news because that standard variable rate is going to move. If it continues to go up, it's going to continue to move. So you're going to go from 894 to way more. I would encourage you, go speak to your mortgage provider. See, listen, I had a very similar conversation. It was about 2 months ago. About 2 months ago. Very, very similar situation to you. Similar age, actually same age to you, but there were two properties on interest only. One was a residential, one was a buy to let. Now, luckily for this person, the buy to let in London had a lot of equity in it, so she had the ability to sell the buy to let, release the equity, pay down her residential mortgage, and be mortgage free on that property with a little bit of profit. But she didn't want to necessarily relinquish the buy to let in London because she saw it as an investment. It's really, really hard because now you're at that point where even if you do apply for a mortgage, they're going to start asking you for your pension provisions. So they're going to want to know, do you have enough pension provisions to keep up with the payments of the mortgage? And if you don't, you're not going to pass their affordability either. So you're just saying, plenty of equity in the property and we'll be able to buy outright. But nevertheless, I'm gutted. Yeah. Yeah. It's a really difficult one. Sheesh. I'm sorry, mate. If I could wave a magic wand, this is the kind of stuff that I would fix. All right, someone's just asking here. Bear me 1 second. I did see this earlier. You're asking it again. I'm going to get to you now. Let's have a look at this. Do you think we will see an uptick in crime as a result of this interest rate hike and financial situation? I mean, it's quite possible. A desperate measure. Sometimes people go to desperate situations, dire measures. Sometimes is what people resort to. I hope not, but I mean, I wouldn't be surprised at all. Someone just saying here, double T, I'm in the same situation as you. 2 years if I'm frugal, mortgage done, have to stay motivated. That's the biggest thing. Listen, so look, what I would suggest in that conversation of staying motivated, what I would do, there's a couple of things you can do. The first one, if you just I do believe in vision board, like be mortgage free, but you've got to be specific. So specificity actually matters here, right? So don't just vision board like a house and put mortgage free on it. Start thinking more tangibly and outside the box. So when you're mortgage free, that day where the mortgage is gone, what does that look like? Are you going to celebrate? If you're going to celebrate, where are you going to celebrate? Like build a picture, like paint an entire scenario. I'm going to go on holiday the day that it's paid off. I'm going to be on a beach. I'm going to be sipping a pina colada. I'm going to be with this person. I'm going to be with that person. Build that out. Don't build out house mortgage free. Build out what you want it to feel like, where you're going to be, the things you want to do. Dream board that, vision board that. And I promise you, when you look at that, you'll be like, yeah, that's going to keep you motivated. The second thing you can do, timeline it as well. Put it in a timeline, and you can do it literally on an A4 piece of paper, right? You document this into like whatever way you document. You can do it on an Excel, whatever, but just put 2 years, boom, mortgage free, and then just write a few things down about what that would actually mean for you, right? How you're going to feel that. I'm trying to tap into the emotive stuff here, because the technical, are we going to pay off, blah, blah, blah thousands, and I'm going to have blah, blah, blah pounds left over and mortgage free. And that doesn't necessarily do it. You've got to tap into the psychological, the emotional side of what that basically means. And if you're able to do that, you will stay on track to anything. It doesn't matter how hard it gets. That's your anchor. That's where you're always going to reference back to, because you've created that emotion, you created that feeling, you thought about it, you visualized it, and you're going to be able to hold on to that tangibly. So try something like that. Edna's is saying here, that's amazing, Pete. It is something I'll be certainly aspire to when it comes to my financial decisions and living debt free. Definitely something to definitely kind of aspire to. Right, okay. I'm just going back down. Do you think interest rates will come down unless house prices come down? These interest rates will mean it's even higher. Harder for young people to buy a house. BlackRock wants all the property. Look, I don't think interest rates are coming down anytime soon, but I could be wrong. So only time is going to tell, but I just don't see it. Not for the next probably 2, maybe even 3 years. I think we'll be on this trajectory of upward pressure on interest rates unless something dramatically changes. So we'll see. Anyway, guys, thank you so much. It has been 55 minutes, and I know that it is a Thursday afternoon as well. I appreciate every single one of you. I'm going to be away for most of next week. I'm trying to pre-plan some content, but I've not been very successful because I've got a ton of stuff to do. But as always, please, there are 117 of you on here at the moment. 53 likes at this point in time. It would mean a lot to me if we can get it to about 70 or 80 likes. That will really help with the YouTube algorithm. And if you have not subscribed, it will be amazing if we could get the subscription up to 41,500. We were 4 shy when we started this live stream. Let me just have a look at it right now because you guys are typically amazing. And yeah, I just want to grow the channel. I want to be as helpful as possible. And the YouTube algorithm sometimes is just, oh my God, it's just one of those things where you just never really understand it. So if you're not subscribed, please do subscribe. Please smash that like button. I appreciate every single one of you. Enjoy the rest of your day.
Yeah, surprise, a little different than you used to. Dropping these bars on YouTube, knowledge I introduce you. We chasing this money like it's the prize, it's the voodoo. Fugazi, fugazi, it's just a lie we buying into. We need some cars on deck. Get the rollies, get the Moe, all the Mars on deck. We got the traders, got the picture with the Bentley in Dubai. Are you dripping in designer looking fly? On the bombardier, sipping on the wine. Broke man, we broke. Where's the fun in being broke? Stocks and bonds get you yo. That's what I'm teaching these folks. I see that smoke, see them choke. Getting coked while I'm researching these stocks. Buying coke. 20 months on the channel, million people taking note. I got a warrant for Buffet. I'm coming for his vote.